Ladies and gentlemen, please welcome CEO and partner of Vertical Equity Group, Shannon Robnett. Shannon is a real estate developer with a principal focus on multifamily and industrial real estate in Idaho. He is a second-generation builder and fourth-generation realtor. Mr. Robnett has lived in Idaho for 40 years and has spent 25 plus years as a developer and builder in that market. His projects include multifamily, fire stations, schools, hospitals, police stations, and more, with 200 million in personal transactions to date. Shannon, thanks so much for being with us today.
Thank you for having me. It's a pleasure to be here.
The floor is yours, sir.
Thanks. So guys, wanted to kind of welcome you today to the Boise Growth Fund presentation. And I just wanted to kind of give you guys a little bit of background on who I am and why maybe it's worth listening to what I have to say. So as as was mentioned earlier, I am a second generation builder, developer, and a fourth generation realtor. And I've been involved in my market here in Boise, Idaho for over 30 years. And I've lived in the market for over 40. I went to high school here. All my kids were born here. So that makes it pretty easy for me to be able to see what's going on, because I'm not trying to bounce back from Tallahassee to Toledo to Tampa. You know, I'm in my market. I've been in my market for a long time, and we've done a lot of things here. And I've done a lot of partnerships here, and I've done a lot of development here. And that's one of the things that I bring to the table is we're not just keyboard warriors at this point. We're vertically integrated, and we'll talk more about that. But I have been involved in over $250 million worth of construction projects, and I have a history of over $140 million of successful developments. The reason the two numbers are different is because we are also a contractor that is a for-hire contractor on the design build side. I've also done multiple 9 figures of personal real estate transactions, both buying and selling on that. And we have almost $100 million under management on various syndications and other projects. A couple other things about me. I also have a podcast. You can find me on Spotify or iTunes at the Robnett Real Estate Rundown. And it's kind of a broad genre of real estate topics, from property management to syndications, to lawyers, to, well, just about every topic you'd like to look at. We also run a RIA here in town, Boise, Idaho, that is all about bringing education and investors together. I have a book club where I publish books that I've read every year because I know that knowledge is there. And there's always more that you can learn from other people. And I think it's always good to continue to educate yourself. Also, I have joined the social media craze called Clubhouse. I'm an Android guy. I don't hold it against iPhone people, but switching apps and different systems has been a bit difficult. But I've gotten through it, and I'm enjoying Clubhouse for all of the knowledge that it has and the ability that we can reach out and conduct business. And I've really received a lot of information on the app. It's an amazing thing. But let's get to why we're here. So I have an umbrella company called SRI, and in that company, we really pride ourselves in being vertically integrated from the real estate transaction, the due diligence, the entitlement, all the way through the construction management, through the property management, and then on to the stabilization, the lending. All of that is done in-house. And the reason that I believe that is really, really important is because time management is really the one thing that we lose control of the most in real estate deals. As we know, time is money. So for that, we have my Vertical Equity Group, which is really about the fundraising side of things. It's all of the equity that's required for our projects. It includes all of the banking relationships. It includes all of the syndicating relationships. All of the funds that come in and out of our businesses go through Vertical Equity. The other one is Phoenix Commercial Construction. I'm also the president of that, and it takes care of building all of our construction projects. It takes care of all of the construction management. We don't actually self-perform anything other than the management. We found that that's a much more liability-free way to go. And it helps us to be able to reach out into our marketplace, make sure that we're using the 27 years of experience that I have in my own companies in this market to be able to reach out, hire the most qualified, the best staffed subcontractors in the Valley, which makes it very easy for us to be able to deliver our projects on time and on budget. The last business that we have, the last that we own, is the executive management services. And executive management services is our property management arm. And as you guys may or may not know, property management is very different than asset management. And the reality is, let me explain it to you this way. If a property manager is in charge of your property, you'll know it because they're about making fees for their company. They're about signing lease fees. They're about renewal fees. They're about the assessments that they make against the tenants. They're about the inspection fees. They're all about those fees, and they're never really that concerned about the NOI. As an investor, all we're concerned about is the NOI, and we really could care less what the management fee is as long as our NOI goals are met or exceeded. So when I started to see how that was affecting my assets and the values of it, especially as cap rates continue to compress, it really changed the way that I looked at things. And so I went out into my marketplace. I hired the best that I could find in the area, which is always what I do, because you can't buy you can't spend your money any more wisely than hiring the right guy for the job. And to be able to do that, you always start at the top. And so at the end of the day, I hired him, brought him on staff, and we've been able to really change the focus of our whole thing from property management to asset management. And what that really means is we're completely focused on the bottom line. The property management company, because that's really what it does manage property, is entirely focused on that. And through that, they're able to drive hard for our NOIs and protect those NOIs and find other sources and secrets in our projects that allow those NOIs to be the best that they can be. The reality is, the first week that I'd hired Jeff, he was starting to look at a 180 unit apartment complex that we were stabilizing. And he realized that there was two areas that he could improve our NOI at $75 a door. And with 180 units, that added quite a bit to our NOI. And it really helped the sales price of that project when we transacted. So it really blew up the numbers, and it really showed me where we needed to be more focused on NOI, not property management fees. And so with that, we've been running that formula all over town here. We now have about $90 million under management right now. We're working on some additional big contracts because people are starting to realize where the NOI can make their property worth so much more. For example, if you just take $1 at a 5 cap, it adds $23 in value to your project. So if you're talking about $70 a door, you can do the math and see what that's going to add to the value of your project. And at the end of the day, that's what we're here for. So we need to add value in every aspect. And what we found is that being vertically integrated allows us to do that. We're able to select the best sites, get the entitlements in a timely fashion, create the budgets. One of the things that we do when we create budgets is we start with our costs in line with what our rents are going to be. So we always start with the rents and we work backwards. We know that we build a budget that will get us to the place we need to be when rents are finally the place, when we're finally in a position to get those rents. And we never wind up over budget, because I've bid a lot of projects where you come back and the owner says, man, I had no idea it was going to cost that much, but they started with the architect. We start with the subcontractors in a solid budget that lets us know that we're going to be able to build this and be successful and hit our numbers that we're looking for so that we can get where we need to go. So let's talk about how we structure what we do from there and see what goes on with our projects from there moving forward. You know, the thing that we find is that, having a little technical difficulty here. We find that the easiest structure to raise funds to build projects is through syndication. And for those of you that don't know, I'm going to take a minute to talk about syndication and make sure that we're all on point with what syndication is. See, the reality is syndication is a fancy word for partnership. And we really view all of our limited partners as true partners in the project, because the reality is all of our relationships are built on trust. All of our relationships are built on trust and track record. And the reality is if we can't deliver either of those, then the syndication is going to be short-lived, as are the other development projects in the future of what's going on. And so we don't want any of that. We want this to be a long-term process, and we want everybody to be happy with what goes on. But in that syndication, we bring on a syndication for each individual project. In that, we have the general partner, the lead sponsor, which is usually me, because we've entitled the ground, we've got it to that place, and now we're ready to involve the other partners in a financial stake. And so the GP is contributing his expertise, he's contributing the deal, he's contributing the capital that got it to this point. Because when we start a project, unlike the traditional value add, we're starting with bare ground. And so we have to have an entitled piece of ground. We have to know that we can build what we want, and we have to have the project and the plans already complete. So for that, we get equity and we receive fees for doing that. The other side of that equation is the limited partners, and they're exactly that. They're limited. They're limited in their liability, they're limited in their responsibilities, and they're limited in what their exposure is on the deal. So they are the ones that are contributing a majority of the capital, the majority of the equity that goes into the deal. And for that, they're receiving a lion's share of the profits, but they're passive. So they're receiving their equity and dividends when it comes time to transact on the project and to move forward with what we know we have, and to execute that, get out of the deal, get everybody's returns, and move on to what's next. But we found that when we were done with that syndication, we had these beautiful projects. But if you're involved in a growth project that takes it from zero to stabilized, you've created massive growth in that area, but you haven't really created a lot of cash flow. And that's where we began to really distill out what we saw our investor groups were. See, there's really two basic kinds of investors. There's those that are investing for cash flow, and there's those that are investing for growth. You know, the easiest way to put that is the difference between my son and my father. My son's 25 years old. He's following me in the footsteps of development, property management, construction. And in that, he is all about growing his money, because right now, his pile of cash at a 7% return doesn't do much more than put gas in the car, right? He's got to get to a place where my father's at. My father's at the place in his life that, regardless of the amount of money he has, that's really all the money he's going to make. And that return has got to put food on the table, gas in the motorhome, dog food in the bowl, so that he and my mother can go enjoy their life. But those two investors don't always work very well together. And so that's where we've come up with the idea of creating this fund. But I want to take a minute and step back and go through the example of what an existing value add project does, and why everything we do is completely different than what you probably know about apartment syndications. See, what really happens in an existing value add is you've got a syndicator that they've got a capital group. They're ready to go on any deal when it pops up. And that call usually happens on Easter Sunday, right? The realtor calls and says, hey, Mr. Johnson down the street is going to sell his apartment complex. We've got 24 hours to put a deal together. We've got 15 or 20 days of due diligence, but then we have to close. Can you do it? And the syndicator says, of course I can. So then they put their offer together. That is what I consider to be the havoc stage, right? Everything is coming undone at the same time. You've got the deal, you've got to underwrite the deal, you've got site inspections, you've got to have happen, you've got to fundraise, legal docs have to happen. Everything has to happen all in that due diligence period. And that's if you don't have to go to a highest and best round with the current property seller so that you can do the deal, right? But let's assume you get all those things and all the boxes are checked, your syndicated partners jump in, everything's good, and you buy the property. Chances are you got that property at maybe 5% under market. That means if it really caps out and it's really tradable at $10 million, you might have been able to buy that at $9.5 million. But now comes the CapEx, right? The syndicator had the dream of changing it from the Tropicana to the Three Palms. It's still a 1973 old Motel 6 with a center courtyard and the motor court portico up front, but they want to paint it a new color of teal. They want to put new lawn chairs around, new carpet, new paint, everything like that is going to change, and we're going to be in great shape. The reality is spending 5 to 20% in CapEx puts you over value on the property. But the goal is that you're going to get through that period of time that usually takes from 3 to 18 months. And then you're going to get to the promised land where you can pull that lever, have that cash flow appreciate through forced appreciation, add value to the project. And now you're back into the cash on cash land where you're getting benefits for your investors in monthly payments, whether that's quarterly distributions or monthly distributions. And now you're going to start repaying the preferred return that you'd been promising them while you were doing the CapEx, all those kinds of things. The reality is that period is now where my father loves it, right? The first period is where my son loved it because he was creating that growth, creating that value. And now it's turned into a cash on cash machine of 7 to 9%. And if you take a 20% growth and add 7% to it, you divide by 2, all of a sudden your returns are starting to plummet, right? But then we get to the last phase where my father and my son can all agree that this was a good deal at the transaction, at the sale. Now the overall project looks like about an 18% IRR, and that's because we had some cash flow, we had some appreciation. It just was a question of how long did it take to create that. That period of time can be 5, 6, 10 years. That's where we're different. So let me give you an example of a project we've just completed, or we're just getting ready to complete, called Colorado Commons. It's a great little 36-unit apartment complex that I have been sitting on the land for 2 years. I've had some other things on the front of my burner, and I've just been worried about this just lately. So in 2019, in December to be exact, I got an appraisal on the project that said it would be worth $6.2 million. My current bid on the project with all my subcontractors, including contingency, was $5.3 million. So I knew that there was a $1 million margin there. The bank that I'd engaged, they gave me 75% loan to cost. I was able to then look at that and go, well, with a $3.7 million loan, I'm going to need $1.8 million in capital. So I put in $200,000 of my own money, $250 to be exact, and I went about building it. With that, I was able to construct the project after raising an additional $1.5 million of my syndicated limited partners funds, and we're almost wrapped up on that project. We'll be in and out of the project in about 13 months. My investors will receive over a 30% return because we were able to create that transaction that was phenomenal in how it performed. See, in the meantime, from December of 2019, I don't need to tell all of you what's happened to our market. It's exploded. And in that explosion, we've seen values go up tremendously. But now we have a completed asset. My investors have made 28, 29%, I think, just under 30%. And now they're going to put that with 8% returns, and they don't really want to do that. But we have this beautiful asset. What are we going to do with it? It's brand new. And those are the questions that we're trying to answer with this fund. So here's some other syndication examples that we have with our current underwriting. The Hickory Flex building, we just closed on that project today. I'm pretty excited about that. We just bought the land. We're halfway through the entitlement process. We'll begin construction in 60 days. The best part about this one is it's in an opportunity zone. So we're combining syndication. We're combining the benefits of tax depreciation. We're combining that with opportunity zones and depreciation that's coming from other deals and capital gains that have been had, and we're adding value right off the bat. In fact, these numbers that are shown are kind of off because the market has pushed so hard that the value that we're going to add to the project just in the original construction and stabilization is almost $1 million because we are doing the original value add. We're not buying somebody else's cash flow and having to put CapEx into it because that's safe, that's stable. We're creating our own cash flow. See, everybody thinks that the cash flow is the stability that you're buying that the bank is willing to lend on. But the reality is when you cross over that line and you over leverage to put the CapEx in, you're really in a bad position because your interest isn't going to carry you to pay that CapEx also. And so you've got to get out of there really quickly. But with construction projects, we get 1.5 times our construction schedule in runway as far as interest reserves on hand. So this one was a minimum of a $50,000 investment, a pref return of 8%. We're going to hold it for 10 years because we want to make sure those opportunity zone benefits are all ours. We've underwritten this very conservatively. We've underwritten it probably to a 2019 underwriting standard. Our cap rates are up there. So are our reserves. They're up there as well. So we want to make sure that we have those. This is one that we broke ground on last month. And this is the Franklin Building Complex. It's also an Opportunity Zone project. So I'm pretty excited. We're creating quite a bit of Opportunity Zone stuff. As you guys know, this is the last year to get your funds into an Opportunity Zone to catch that tax benefit. And if you need more information on that, I'll be available later. We can talk about that. But this one's a 20,000 square foot flex industrial building that we will be building and stabilizing. We're about a 21% return, a 2.7% equity multiple, and we're going to hold that project for 10 years too. Both of these are fully funded and closed. But this is what brings me to this point of why create a fund, because we're creating these assets, we're creating them for growth, and sometimes a syndication is a little bit too rigid. A syndication doesn't allow us the flex and the flow of people wanting to get in and out, and it works for now, but it doesn't work for later. And so we're looking at that going, hey, maybe our growth LPs want to be able to get out, and maybe they want to go to the next growth fund. And maybe our syndicators that really want cash flow don't want to be locked into one. They don't want to have to do their due diligence on each individual asset, and they want to know that they have some liquidity. So the things that a fund does is it gives us money for acquisition of land. One of the things that we're seeing in our market is how fast land is going. Things are going under contract and closing in 30 days without entitlements. Being able to have access to land allows us to close properties quickly, get the entitlements, and then sell it back to the syndication and make money. In fact, in the last 3 weeks, I passed on $5 million money makers that were quick in and out, 4-month deals, but they took capital, and you had to move on them fast enough that you didn't have time to involve traditional banking. The problem with that is that you need cash. The solution to that is a fund. The reality of a fund is you have to make sure that you're doing things that are in your market. You're doing things that you're familiar with. And that's where my background and 40 years in this market, 27 years of running my own companies in this market, have really led me to believe that I think I've got the track record to be able to back this up. But then with the fund, we'd be able to capitalize on entitlements, close deals quickly. We'll also be able to sell depreciated assets and move in and out of assets as necessary. But the reality is we are going to be locking ourselves into long-term investments because we're going to be buying brand new product. We're not going to be dealing with somebody else's 1973 Motel 6, like I talked about earlier, that is 3/4 of the way through the HVAC units with 50% expense ratios. We're going to be dealing with brand new product that has warranties. We're going to be dealing with product that more than likely is going to be underwritten and funded by the 223F program, which is a HUD program, 35-year amortization, non-recourse, assumable product that will allow us to have access to massive amounts of cash, 85% LTV, with a 35-year fully amortized product that will give us a long window of catching that return, as well as having the market continue to appreciate. So what it will help us do is it'll help us to be able to find good deals faster. It'll help the investors not have to be an underwriting expert to go in and dive in on each deal, but knowing that the market that we have, Boise, Idaho, is ranked in the top 3 behind we're constantly being compared to Austin or Houston or Dallas, even said that we're above Denver. See, we've seen 16% year over year rent growth. We took 3.4% rent growth last year. You guys understand what that does to a cap rate, but we also know that that's accelerated everything that's going on in our marketplace, and deals have to be done quicker. So a lot of people are seeing that, hey, we're coming out with another deal, but I don't have time to review it. If you're in the fund, you're going to be able to see where you can churn that and be able to know that you're invested in a really great market. You're going to be diversified in a concentrated market, but diversified among several assets in several different asset classes. You're going to be able to invest like a pro and be as involved as you want to be without having to be tied to just one product and just one syndication. So it's going to add some of that diversity that everybody in here is looking for. So this helps us transform the no's into yeses. No, I don't want to be locked in on this one syndication. No, I don't just want growth. Yes, I do want cash flow. So we're going to be able to answer a lot of those questions where traditional development syndications tend to struggle a little bit to be able to check all the boxes and make all that stuff happen. The reality is you guys are seeing today the launch of this fund. With this fund, we're going to be able to lock in one of these primary assets that is going to be the Colorado Commons project that I talked about earlier, that we're going to be able to get involved with at a substantial discount because we're not involving sales personnel. So when you typically find a deal, unless you're an off-market wholesaler, there's going to be realtors involved. Realtors are worth their salt. They definitely do a lot for us. As a fourth generation realtor with fifth generation in the room next door, it's definitely something that's near and dear to my heart that I know is realtors do provide value. But the reality is when we're getting involved in a project, we can eliminate those because we're transacting between two companies, right? So we know what our cost is. Like I said, the appraisal on that project was less than what the value is currently, which allows us room to be able to pay more for it, cut out the realtor's fees, save some money, and lock that piece in as one of our cornerstones that's going to provide consistent cash. You guys can understand what happens when rent growth grows by 16% in a market year over year. We've underwritten it at 4% rent growth, and that still provides us, still puts us in a situation where the cash on that one single asset climbs to over 12%, cash on cash inside the first 36 months. So we'll be able to capture that, right? We've also got another brand new asset that we're going to bring into the fold that will allow us to capture 3 or 4 of those. We've got a couple of development deals where we're under contract on a couple of shopping centers that we're going to repurpose for multifamily. It's going to be some phenomenal projects where we're going to be able to capture some upside growth where the Pref 8 that's played out by the fund is going to be locked in by these income producing assets with the reality that we're going to be catching some pretty significant upside. The other thing that was going to happen is we're going to be able to get the bonus depreciation. Now, I know the slide says bonus appreciation, and we appreciate you. We really do. But the depreciation is something that is a tax benefit that we're all going to see, right? So when we look at these and we say, gosh, you know what the difference between single family and multifamily is? It's the fact that the bonus depreciation is there. See, single family, you're on a 27.5-year flatline bonus or flatline depreciation. But when you talk about multifamily and industrial, you're able to take and do a cost segregation study that's going to allow massive depreciation to happen. We did that on a project recently. It was about a $12.5 million build. Very first year, we took $1.9 million in bonus depreciation. That's going to be dispersed to the fund members, and there's going to be some bonuses on that based on the size of the investment as we found this fund. So we're going to be doling out depreciation, and we're going to show you our appreciation by giving you depreciation in this fund that's going to give you all of the benefits of real ownership without all of the locked-in process of having to be involved in the syndication. The other benefit of why this fund will be better is because the liquidity. In a syndication, you can't get out. You'd have to resell your stock. You're limited in how that happens. In a fund, you can let us know that you're looking to transact and get out. You've got some other things you want to do. So it's a great placeholder for people to be able to deploy funds for 2, 3, 4 years and be able to have liquidity come in, have payments come in, be able to harness that cash flow, see appreciation happen, and all of those things. But I think the biggest thing that we're going to do in our fund is we're going to lower the churn rate. See, if you guys are aware of what happens with syndicators or asset managers, there's an acquisition fee and there's a disposition fee. And you'll notice that a lot of asset managers or a lot of fund managers have a lot of churn in their fund because that's where they make their money. They're churning it when they buy it because they're getting an acquisition fee. They're getting a finance fee. They're getting an inspection fee, right? There's a bunch of fees loaded into the front side. And they're getting all of the disposition fees on the other side. So the quicker they can get it in, get it to do what it's supposed to do, create some cash flow, and then liquidate the asset, the more churn, that's a technical term, it's an industry term really, the more churn that happens, the more fees they make. But where we're looking to bring in brand new assets with long-term financing and a long horizon for holding, we're going to lower that churn rate, which is going to produce much better results for our investment group. See, we believe that with good investment policies, we're going to be able to reward our investors a little bit better than we would normally if we were doing a lot of churn. And with that, they're going to tell their friends and family, we're going to have more funds to manage. This is going to be a great circle that is going to help everybody. So in that, we're going to be able to put together a little bit better fund, I believe, than most people, because we're going to lower the churn rate. We're going to put brand new assets in there. We're going to be able to do some of these deals that are coming up that are allowing us to be a quick in and out, that liquidity helps us to do. And so those are things that will distinguish this fund, plus the fact that it's only going to be focused on the Boise market. And in that focus, we're going to be able to deliver a lot better product. Now, what I want to tease you guys with, hopefully you guys will join me later after this production or recording here, where we can talk more about the Colorado Commons, which will be the cornerstone. It will be the model of the brand new assets that we're bringing into the deal. See, this one's going to produce a cash on cash of 8.5%. That's just in the initial underwriting. A 12% IRR on the total year, that's going to be excellent for this as far as what's going to go on. 50 to 60% bonus depreciation in the first 24 to 30 months, depending on how that cost seg study comes out. That's going to allow us to do some massive things on the tax side of things, because all of you are accredited investors and you know that the biggest single line item in your investment world is Uncle Sam. And eliminating him and lowering that tax burden is massive for you, because you're going to probably wind up with 37 cents on every dollar of savings, because you're going to wind up not having to write that check. This one, we're going to have a hold time of about 10 years. I'd like to say we're going to hold it for more. We don't know. But the reality is, what people are paying for new real estate these days, it may make more sense to sell it if we've got the opportunity to get into something else. So I want to ask you guys to stick around for that so that we can talk more about that in our deep dive. If you go to my booth, which you guys were all able to find to get here, you're going to be able to find the Zoom link. You can join me in the room after that. You can also visit me at shannonrobnett.com, myverticalequity.com/growth fund. You can contact us here. You can email me. We're all over the place, and we want to talk with you guys further about this. And so with that, guys, I'm going to kind of conclude my presentation, open it up for questions, hand it back to the moderator, and see what we can do to further answer questions and deal with the subject and the topic. And hopefully you guys have enjoyed the presentation. Thank you for your time.